So I wanted to kick off today by talking a little bit of background in this presentation. Research tells us that the advice requirements of Australians are changing, and that's research that Zurich and myself have done for quite a period of time, but also research pieces such as the Greater Wealth Transfer, which is a piece that Accenture did in 2012. And what you'll see when you look at that research is that certainly from a health and lifestyle point of view, boomers are experiencing better health and life outcomes, and consequently they've driven and they will continue to drive self-managed superannuation fund growth. On the other hand, Gen Xers meanwhile are looking for more value from their advisors and meaningful solutions that are very much in keeping with their lifestyle. And right now, sadly, only 1 out of every 2 wealth management clients in this 30 to 49-year-old age group, which incidentally stands to inherit from the boomers, is actually satisfied with their primary wealth provider. Now I say sadly, but that's a fantastic opportunity for everyone who's dialed into this webinar, because this attitudinal and behavioural shift has advice implications. Advice businesses need to prepare for clients who not only require longevity from their funds, they may indeed actually continue to work past retirement age, and as a result they'll need more complicated strategies as well as considering the tax and estate implications as well. So it very much requires a different approach from the traditional retirement planning, which, for want of a better description, was that someone would retire and in a short space of time, as life longevity was not as prevalent as it is now, they would actually pass away. We've got a longevity and an income pool problem where we need this money to last. For Gen X clients, establishing tax-effective cash flow strategies is certainly becoming a growing focus. So what we're going to do in this presentation is we're going to take you through some conversations. They're very much designed to engage clients and also alert all of you to the opportunities and the key issues that need to be considered to offer really differentiated and high impact strategies to a range of clients. So the outtakes here are very much, let's understand the opportunity and need for insurance advice, particularly in the retail platform market. We really want to understand and be able to demonstrate that we do understand the tax implications of holding total disability insurance via a platform, and subsequently looking at how superlinking can assist in mitigating some of those issues. Marketing to centres of influence and to accountants in particular around the self-managed superannuation opportunity. Well, I really want to equip you with some resources that you can start using immediately to not only engage clients but also engage your centres of influence as well. And we will touch a little bit on and LRBAs. That's a fairly convoluted and changing landscape at the moment, so we will touch on that, and particularly just mention very briefly some of the changes around cross-ownership of insurance policies. But the big thing I want to really get to is assessing industry fund offers and realising the advantages and being able to equip you with a really dynamic and very positive conversation of the advantages of retail offers available through platform versus the industry fund offers that some of your prospects may actually have. And finally we'll finish off with some estate planning conversations, and the intent here is for particularly those advisors and businesses on the line who are partnering with Netwealth and want to partner with Zurich as well. Then there's a great offer for you to give you a diagnostic on estate planning that you can use with your clients, and we've had an enormous amount of success with businesses using this with their clients to really create a robust estate planning service, but also lead on to wealth planning solutions and insurance solutions. So very much as Keely said at the start, this is about some insurance strategies that your clients really want to talk about, and this is based on all the research that we've done and what clients actually perceive as important to them, and they're very much their wants as opposed to us defining something that they need but haven't really been cognizant of the need and how it fits into their world. So The first where we'll start is very much around insurance and platforms. So we already mentioned that there's this attitudinal and behavioural shift occurring, and it's leading advice clients and those who require advice to demand more from their advisors. And clients in this age range of 35 to 45 particularly, they're looking for value and collaboration, as well as cash flow efficiency. We've also got the complication of self-managed superannuation funds looking at properties in their self-managed super funds, and boomer clients having this greater need for more complicated tax and estate strategies. For all of this, insurance plays a role in satisfying and securing the outcomes that these clients are looking for. So when we look at insurance via platform as a starting point, let's position this by looking at what Investment Trends said recently about insurance on platform. And they did an analysis of financial advisors and their use of insurance and found that nearly 40% of new risk business is written via a platform. And according to the Investment Trends senior analyst, Recep Peker, great name, the percentage of risk premiums written via Master Trust or wrap platforms has really grown from almost zero in 2003 to this moving towards 45% today. And this is particularly significant when you think about it because of the limited range of insurers available on most platforms. As you move towards a greater range of insurers on offer, Investment Trends particularly believe that more risk business would actually start to be written via platform, mostly because planners believe that this structure allows them to provide the best deal for the client, and this was reported in Risk Info amongst other places as well. So, you know, hats off to organisations like NetWealth who expand their panel of insurers and have consistently supported this premise of choice. But when you look at insurance platform, this is where we start looking at the opportunity here. Platform data indicates that 57% of platform clients are aged between 36 and 55. And there's about 37% that are aged between 36 to 45. Now, what we do know about these clients is that the average life sum insured via the platform for these clients is about $870,000. And this is data that we've sourced from the likes of NetWealth. Now, this sum insured amount is really critical and highlights the benefits of seeking advice, because when you look at something like IFSA, the Investment and Financial Services Association, they approximate the average level of cover for term life insurance at around about $235,000. They go on to further demonstrate that disability income insurance is about $3,700 a month, and the average level of cover for trauma is about $165,000. So these are woefully inadequate amounts, and they're well and truly surpassed by what's occurring in a platform solution for insurance, with life cover being more than 3.5 times the average. And when you look at what's the legal minimum for an industry fund, it's $35,000 of insurance for a 36-year-old. So the story for the average non-advised Australian is incredibly poor. And Zurich's own research into the community's understanding, or the population's understanding on insurance, highlighted that after speaking to nearly 400 working Australians, there's absolutely a misalignment between their financial situation and their stated risk prioritisation. And there's a significant lack of knowledge about their superannuation-based life cover, especially around what were they covered for, what are the waiting periods for the income protection benefits they may or may not have, and the vast majority of respondents out of that 400 had never conducted an analysis about their individual life insurance needs. So when you put all of this into context and you consider that the average Australian has a home loan liability of $319,000, clients who have not had the benefit of advice are really precariously positioned. And it's even more startling when you consider that 81% of these 36 to 45-year-olds believe they can only survive after a disability for less than 12 months. So there's a big opportunity here. There's an advice opportunity. Not only with the Australians who are not engaged with the advice process, I mean, data tells us only 1 in 5 are, but there's also an opportunity with those people with only 1 out of 2 of them satisfied with their current advice provider. So there's an opportunity for you, because if you understand the issues facing this age group. If you create solutions to these issues and you can communicate and collaborate effectively around the solutions you engage and enact for this age group, and these are things like cash flow management, debt recycling, mortgage solution, but also the main game here is providing a safety net in terms of the most cost-effective manner through insurance, and that essentially is insurance via superannuation. So insurers have responded. They've responded to provide solutions and mechanisms to create this optimal insurance solution, an optimal insurance package utilising the superannuation environment. And certainly Zurich's not on their own, but Zurich's response had been to allow super linking, obviously, for disability benefits inside and outside of super. So for example, what that means is you've got the income protection agreed value and ancillary benefits outside of superannuation, with the premiums outside super approximately 20% of the total premium, so you're getting immediately a reduced cash flow burden. And you've got similar arrangements, of course, for own occupation TPD. And also the move into the platform space by quite a few insurers has certainly enhanced the proposition that an advisor can have when positioning a platform where there's multiple insurers. But it's good to keep in mind that from July 2014, the 1st of July 2014, the rules around insurance in superannuation changed. So the regulations prohibit trustees from purchasing insurance policies to provide coverage for members other than that which is consistent with the conditions of release for death, terminal illness, permanent incapacity, temporary incapacity. And of course these restrictions apply to new policies. So from July 2014, what was okay in super was life, TPD, any occupation and income protection. Certainly there was grandfathering that applied to TPD, own occupation and trauma established before the 1st of July 2014. So that's important to consider for existing policies that you may be reviewing. But for our discussion today, I really wanted to focus on TPD. And you know that TPD can no longer be purchased entirely inside super. The any occupation retail definition includes a reference to reduced earnings, example 25% earning capacity, and this certainly allows a lot of flexibility at claim time, but that clause is not present in super owned policies. And further, TPD generally has a tiered definition. You've got a working definition, whether that's own occupation, any occupation. You've got an activity of daily living definition. You've got a loss of limb and or sight definition. You've certainly got definitions around significant cognitive impairment and of course this earnings capacity, which is a 25% rule. Add into that, for a non-working spouse, the superannuation policy will have an additional component of being unable to engage in employment. So what does this all mean? Well, what this means is you've got to take care when reviewing clients who may actually have more generous definitions, and note that the definitions inside and outside superannuation will be different. So as an example, under super, the definition of permanent incapacity is that the trustee of the fund is reasonably satisfied that the member's ill health, whether that's physical or mental, makes it unlikely that the member will engage in gainful employment for which the member is reasonably qualified by education, training or experience. So there's two different definitions of any occupation depending on whether the TPD is held inside or outside of super. So certainly the working definition, that's as per that permanent incapacity definition, loss of limb and sight as per ADL, significant cognitive impairment as per ADLs, that earnings capacity 25% rule, that's removed, and partial TPD not realistically available inside super. And for IP, one of the main concerns is the requirement to cease gainful employment. Because if you look at that strict interpretation of that definition, it may mean that those who are unemployed at the time of disability or those who are on unpaid leave can't actually claim on this provision because they don't have the ability to cease gainful employment. So very much relies on the temporary incapacity definition under super, which what that's talking about is that's in relation to a member who's ceased to be gainfully employed, including a member who's ceased to temporarily receive or gain or reward under a continuing agreement for the member to be gainfully employed. It means ill health, and it's caused the member to cease to be employed but does not constitute permanent incapacity. And what we do know there is all of these ancillary benefits, the policies are very much stripped down. And the available benefits inside super, you've got an income benefit, which is very much indemnity only. You've got a funeral benefit, maybe a basic death benefit. But certainly it's not going to be suitable for people with more complex needs. So you've got different products versus a stripped down version. If it's a stripped down version, there's going to be a cost difference. There's certainly differences and implications with changing ownership. And access to benefits is also a really key consideration if you're considering IP inside super, because keep in mind that those insurance proceeds are paid by the insurer to the super fund and then the super fund to the member. So that needs to have a condition of release met. So the member, either in the case of TPD, has reached preservation age, or they've retired, they've attained 65, there's death or terminal illness, or there's a permanent or temporary incapacity. The release on severe financial hardship and compassionate grounds is pretty restrictive. It's up to $10,000 in any 12-month period. And what my key point here is that clients really need to understand the impact of this. One of the things from the ASIC 413 report, and don't get me started on the probably flawed and skewed sample size on that, but sadly what did come out of that is whenever insurance was funded via superannuation, there was quite a considerable lack of information regarding these points, the pros and cons of having it through superannuation, and certainly there was a significant lack of the discussion of tax. Now, what we do know regarding tax, and what I really wanted to stress typically for TPD, is when a super fund owns an insurance policy, those insurance proceeds are paid to the super fund and form part of the member's super interest. So for the member to access those super benefits, they've got to satisfy a condition of release. So for a successful TPD claim, commonly a member who hasn't attained preservation age, they'll access their super benefits by satisfying the permanent incapacity condition of release. And that's where the super fund trustee is satisfied that the member's unlikely, because of that ill health, to engage in gainful employment. And there's a component here. There's a tax-free component of a disability lump sum, and it can be increased in accordance with the formula, which is basically the amount of the benefit multiplied by the days to retirement divided by the service days plus the days to retirement. So the days to retirement, of course, is the number of days from the day on which the person stopped being capable of being gainfully employed up until his or her last retirement date. And that last retirement date, if an individual's employment or office would have terminated when he or she reached a particular age or completed a particular period of service, the day he or she would reach the age or complete the period of service, as the case may be, or in any other case, the day on which he or she would turn 65. And of course, the service days is the number of days in the service period for the lump sum. So the question here is, if you did consolidate superannuation, got multiple sources of super and you consolidated it, how does that actually impact on a potential TPD payout? And here's a little example that we've got here on the screen. And let's assume that we've structured an insurance solution in this way. And the clients let us know that their outside superannuation budget for insurance is about $150 per month. And we certainly want IP, so we've structured the IP outside super, and in this case on a $7,500 sum insured for a 40-year-old male non-smoker, and they're paying $140 a month for that IP. And so the cash flow situation of the client, they only had $150 outside of super to spend on insurance a month. It's dictated that the life and TPD are going to be run via superannuation. Now, the best news, of course, typically, is that we could probably consolidate some small superannuation accounts into our platform of choice, hopefully NetWealth. But what have we actually done to the potential TPD payout? So here we have our 1 million TPD sum insureds, and we've consolidated superannuation funds to save on fees, for ease of management, maximise final retirement benefits. All of these are absolutely valid reasons. But in doing so, we've got the potential of having picked up an earlier start date, which has flowed through to the insurance-only component. And what this has done is created a tax liability and reduced the TPD payout to just over $900,000. And this is when I say, when is $1 million of TPD not $1 million of TPD? It's when you have it via superannuation and the person has suffered a TPD event before their preservation age. So that start date of that super fund, of course, is determined by the earliest of the date the super fund commenced, but also the date employment commenced with an employer that's contributed into the fund, or the start date of any rollover super benefit received by the super fund. So any time that a super fund receives an employer contribution or a rollover, the receiving super fund may actually pick up an earlier start date. And so this is particularly important to be cognizant of this for an insurance-only superannuation product when perhaps changing the source of funding to pay for the premiums. So prior to changing that source of funding for the premiums, any impact on the start date and resulting potential net insurance benefits really needs to be not only identified and managed, but also communicated to the client. And that was certainly one of the failings that was picked up in the ASIC 413 report. Now, one thing, the question that I'd ask the audience is, what do you notice about and what can you tell about the taxable component formula? And what it is that over time, the tax-free portion of the disability lump sum will actually reduce as the service period increases and the days to retirement decreases. So without a regular review taking into account the tax implications, at any point in time, the clients may be underinsured or they may be overinsured, which results in them paying additional premiums that are not really necessary. Now, it might be surprising to some of you on the line, but this is actually a great advice differentiator. Part of my role is in the Advisor of the Year judging, and which means not only do I meet a whole array of advisors face-to-face and over the phone, but I get to review a lot of files. And when there is advice that's given for insurance via super, one of the first things I go to is to have a look at whether or not the tax implications have been discussed. And I can tell you sadly that they're not. So if you think this is pretty basic and this is something that you do know and talk about with clients, well, I'd be really making sure that you spell this out. And when you're reviewing clients perhaps may have come from elsewhere, really picking this apart. And it's a great advice differentiator, but it's also an opportunity to review existing clients and really capture the attention of new prospects. But you can have the best of both worlds, because certainly you can look at something like super linking, which has been out for a little while, but yet when we do go to PD days and the like, we see some confusion, and I think a lot of that confusion probably has to do with the illustration software, some of which is not too easy to navigate. So essentially how this works, of course, is that you can split the super and non-super components of certain policies, and in this example, particularly TPD and income protection. So you can take out any occupation cover via super and have a linked amount, which is the own occupation cover. And you can do that same with having the core indemnity cover via superannuation, having the agreed value components and all the ancillary benefits via super. Now, the benefit of doing this from a cash flow point of view is that approximately, depending on the types of policies, 80% of the premium is funded via superannuation and 20% outside. Certainly you could argue that perhaps taking the better tax deduction for IP is more advantageous than maybe diluting the policy in this way. But certainly for TPD, because of the claims assessment process, really does ensure the client gets the best possible outcome. This is a fantastic cost-saving measure when a client presents with a certain budget for the ability to fund insurances outside of super. This is a fantastic way that you can stretch that budget as far as possible while maximising the overall insurance package that's available for a client. If you do have questions on super linking, this is something any reputable BDM can do. They can take you through the navigation of it and how to set it up, and then really show you the examples that the cash flow benefits for your clients, which I'm sure a lot of you will be across. But look, this is available and certainly now very much easier to use on our software, but of course others do have this as well. But certainly worth talking to your risk representatives about. But let's step into self-managed superannuation funds. Now, there's more than 1 million, 500,000 self-managed superannuation funds now in operation, and that's according to the latest statistics released by the ATO. The approximate number is about 516,000, but there's thousands of new self-managed superannuation funds being established every quarter. And it's interesting because the average balance of a self-managed superannuation fund now exceeds $1 million. And the average account balance for a self-managed superannuation fund member is just over $525,000. And when you look at that growth, individuals who are running self-managed superannuation funds control nearly a third, about $520 billion of the 1.7 or thereabouts trillion dollars invested via Australian superannuation funds. And just compare and contrast that, because 10 years ago, DIY super funds represented only 1/10 of all superannuation money. So absolutely there's an opportunity here for your advice, but particularly for insurance advice. Because with what all the insurance houses, insurance providers have been active in speaking about has been the actual requirement for trustees to consider insurance for members. But when you look at the facts, there's certainly a need for this discussion. It's a discussion that's not being had, because only 15% of members actually have any form of insurance. So when you consider those numbers as above, as we've previously discussed, there's certainly a huge opportunity here. So the key here is this communication with trustees and accountants and assisting self-managed superannuation fund trustees to comply with this requirement. Those trustees can only discharge their duties if they are aware of the circumstances of the members. So it's actually absolutely important to provide documentary evidence of this awareness. So what this is all about, it's about engaging on the topic, not just a mail out, but absolutely real engagement. And we've developed 3 mechanisms for you to be able to do this. So the first thing is something that you can use with accountants and trustees. The second's a letter or communication to use with centres of influence and send to self-managed superannuation fund trustees. And the third and most successful is a all-encompassing wealth index, which has now been digitised. So really basic letter here or communication. It's using that concept of social proof and third-party endorsement to say, here's some valuable information. Congratulations on setting up so you can get a centre of influence perhaps to send this out, or market your centre of influence clients with this type of marketing piece. And it refers to Money Smart, which is a guide for trustees, and it talks about what are the roles for trustees, but also it provides them with the ASIC tip, which is basically saying, take out life insurance cover, and you'll typically need these types of covers. So this isn't you suggesting this is ASIC, and this is from Money Smart. And you can change the language where you see fit, but certainly it's just an information guide that goes out to clients, but is also providing them with some proof positive that this is something that they actually need to consider. Stepping on a slight different variation, talking about what's actually changed and alerting self-managed superannuation trustees that they do need to be cognizant of these changes, and hence there's an opportunity here to work with a professional advisor to review current insurances. And so this is definitely a marketing letter that perhaps a centre of influence can send out on your behalf, and referring to you as the insurance or advice specialist there is in the last line. So a couple of tools that you can use to start raising this awareness with your accountants, but also with their clients and with your existing self-managed superannuation clients. But the one that we have had great success with, and this is the non-digitised version, this was a base questionnaire which gave a scoring methodology, and it was something called the Wealth Index. And the Wealth Index basically stepped through a range of questions around insurance, but also around business protection asset protection, superannuation and self-managed superannuation fund, and gave specific scores, but very much was designed to give a low score. So typically your average person filling out these questionnaires would score around about 40 or 50%, and then hence highlight the need for advice. Now what we've done with this is we've digitised it. So we've created a survey that you can personalise. You can add your advice details. There's no branding on it, so you put your branding on it, you put your photo, your logo, and you can send this link out via social networks. You can add it onto the end of an email, you can put it in a newsletter, or you can send it specifically to clients and prospects, and within about 30 seconds to a minute, a client can run a diagnostic on their financial health and be given a percentage score. The score comes up in red or green traffic lights, so certainly where there's a lot of red, and then it alerts them to contact you for advice. But also, more importantly, you get a notification that they have actually completed that survey, and you get the answers, so you can proactively contact them and say, look, you actually didn't score very well here, or there's certainly some issues. Now this diagnostic, that's available through our Flipchart application. It was something that we added, I believe, I can't remember when I pressed the button on this, but I think it was last year in September, added the wealth index in there, and that's something that we can customise and personalise to your own business. And businesses have had an incredible amount of success with this. In about 2 weeks' time, there'll be some robo-advice screens where you can then, once the client's in, have a complete insurance conversation on one iPad screen or one desktop screen. So that's coming. We'll put some press out about that. But here's some tools that raise this question of insurance and self-managed superannuation, but also talk about the platform space as well, which talks about this consolidation issue as well and review. So something you can certainly use proactively. Now, LRBAs. This is an interesting space and a movable feast, really. So I'm sure all of you know that an LRBA is a type of loan structure where the only self-managed superannuation fund asset that the lender, or any other party for that matter, has access, or in other words, recourse to, is the asset that was purchased using the loan in the situation where the fund is unable to meet its loan repayments. So these arrangements typically involve establishing a security trustee that legally holds the assets on behalf of the self-managed superannuation fund. So this bare trust type arrangement broadly recognises that that asset is to be held by the security trust until the debt is repaid, at which point legal ownership can pass to the self-managed superannuation fund. Now in most situations the LRBA is used to purchase an investment property, but look, it can be used to purchase direct shares or even managed funds. However, an LRBA can only be used to purchase a single acquirable asset. And those, most importantly, an investment in a related trust held by the self-managed superannuation as part of an LRBA is excluded from being an in-house asset of the self-managed superannuation fund. Now, there's an impact here, however. What's the impact of a death or disability and cash flow, considering there's a liability for the loan? So the answer very much is there needs to have a solution to clear the debt, and what are the options here? And it can be quite problematic because where the member of a fund that has borrowed dies or becomes permanently incapacitated, the surviving trustees may be actually forced to sell the asset in order to pay out any lump sum benefits that are required to be paid out. Or most importantly, because the fund won't have sufficient cash flow to be able to continue to repay the loan. And this may be especially the case where the loan and the approval process for the loan took into account the members' contributions. So it could certainly have a number of potential negative impacts on the fund, including, well, potential reduced investment returns associated with being a forced seller. There could be increased taxation costs, transaction costs rather. The fund being forced to sell the property prior to conversion in a pension phase, so resulting in realisation of a taxable capital gain. Or the fund being forced to crystallise capital losses. Or worse, the fund needing to be wound up, it's no longer required or justified from a strategic or cost perspective. So to manage these risks, the trustees really should consider implementing an insurance strategy that would provide the necessary liquidity to extinguish debt and pay benefits in the event of the unexpected death or disability of a member. So where the fund is able to pay a death benefit as an income stream, so for example the surviving spouse is a member of the fund and or would be able to become a member of the fund, this strategy here just involves simply taking out enough insurance over each member to allow the trustee to extinguish the debt. So in the event of the death of the member, the trustee would then allocate the value of the insurance proceeds to the deceased member's account as per normal, and then use the fund's assets, including the cash from the insurance policy, to extinguish the debt and commence paying the deceased member's benefit in the form of an income stream. But to implement such a strategy, the trustee is going to need to consider a range of issues, and these include, well, the trust deed needs to actually allow the trustees to acquire insurance policies and pay debt benefits as an income stream. So reviewing the trust deed is incredibly important as part of your advice proposition. The investment strategy of the fund should specify that the fund will actually hold insurances for liquidity purposes as part of that LRBA arrangement, and that the fund can actually afford the cost of premiums. Note that the premiums, of course, would be fully deductible based on the fact that the proceeds would be paid as a debt benefit. But the real complication arises is, what if the fund could not pay out the debt benefit as an income stream? For example, it was business partners and it was business real property, or there is no spouse. Now this is where you've got a few shady areas in terms of the practice of cross-ownership, because what the cross-ownership member strategy was involving the members effectively holding insurance policies over each other and then thus providing required liquidity should one of the members die or become disabled. This is all under review and under consideration here at the moment, and if you are dealing with LRBAs and particularly business real property, this is an area of specialists outside the scope of this presentation today and in the time frame we have, but certainly something we should be talking about. You need to be on top of that planning opportunity. There's associated tips and traps. In the past, a well-drafted cross-insurance deed could ensure that the self-managed superannuation trustee is really clear on whom and how insurance proceeds to be allocated, but this is certainly a space that the ATO has questioned the cross-ownership and made several statements about. So there's a lot of conjecture here, so I'd just be treading very carefully and getting specialist advice on this. But the area that we really wanted to cover off in is industry funds. And the opportunity that lies. So here's something from the Herald Sun. This is fantastic because it's mainstream and certainly the message is getting out there. And the main points from this article were that white-collar workers were paying at least an extra 15% according to super ratings. Retail and master trusts, by contrast, were charging slightly less than they were 4 years ago. And I'm sure you've seen a lot of the retail offers, certainly from Zurich. We've actually been reducing our term and TPD premiums in certain age groups, and as an average across the industry for retail funds, there's been a decrease in premiums of about 2.3%. And the question here is particularly on industry funds, is that those increases no doubt would have a detrimental impact on the retirement savings of members, particularly those with higher levels of insurance. It's interesting though, the Australian Institute of Superannuation Trustees, their chief Tom Garcia said at one point premiums were cyclical depending on demographic trends and claim numbers, and said that generally speaking insurance through your super fund is still very good value and much cheaper than elsewhere. Well, I tend to disagree with that because it ain't necessarily so. Particularly when you see some of the dramatic increases, such as the 27 plus 40 plus 50% increases that you've seen through industry type funds. So when you actually do a comparison of what's prevalent in the market now, and I've used the example here of Australian Super versus a Zurich policy, you can see here for a 35-year-old there's an initial premium saving immediately, but you've also got a significant saving over the next 10 years. But more importantly, you're including the cost of advice in the retail offer, so the advisor is getting compensation and the client has a yearly average saving over a 10-year period. So this is very much a compare the pair that I really like. Love comparing these types of situation where not only is the client getting good advice and probably an adequate level of cover versus what typically is the norm through an industry fund, but also getting it at a much better better price. And in terms of the features, when we look at the actual features that are available, having a look at the slide there, you can see immediately some of the things that are not available through the Australian super offer, but certainly come with a typical retail offer. So when you look at this, automatic cover through these types of employer and industry funds, little or no evidence of health, but the terms and conditions aren't guaranteed to stay the same. So it's really important that the insured knows that they don't actually own that policy. The control is ceded. They have no direct relationship with the insurer, and all dealings are via that third party, which is either the fund trustee or an employer. And typically the cover ends earlier, and the definitions can alter as well. Under a range of circumstances, the cover could stop if the member ceases work or employer contributions stop for a period of time. And generally they're not portable if you leave a fund or become ineligible. From a TPD point of view, despite the fact that people are working longer, typically in an industry fund the TPD reduces from age 61 each year until you reach age 65 when it's nil, and pre-existing conditions may not even be covered, even under an automatic insurance sum insured. And that IP cover definition of disability may change after 2 years. There's all these little nuances. Restrictions may apply for someone travelling overseas, and IP claims are nearly always assessed on an indemnity basis. That's proof of income must be supplied at that claim time for these industry funds. A lot of offsets, shortened return to work provisions in the IP waiting period. In many cases see an unwitting sort of restart of the waiting period, and you've got certainly a definitive lack of options such as agreed value or buyback after a TPD, and you certainly have no choice of level premium. Not to mention how do you amend it? There's no ability to use things like memorandums of transfer when you've got a divorce, or there's potential for uncertainty. So there's a lot of uncertainty, let alone price alone, but we can give you the full gamut of all of the different types of restrictions that you can raise in conversations. So there's certainly areas where retail is significantly better. I mean, for a start, it lasts longer. I mean, we've got it guaranteed 99 to life, 80 to TPD, 70 to IP, guaranteed renewal, non-cancelable. The owner is the only real entity that can ever cancel the policy. You've got the upgrades that many of the insurers pass back on. You've got flexibility to change ownership. You've got typically completely portable. And in a lot of instances with good quality IP contracts, receipt of other payments like sick leave aren't offset against the IP, let alone life cover buyback, let alone the ability to link own occupation and to TPD cover and do the super linking. There's the ability for children's cover, the ability to insure income protection on an endorsed agreed value basis, so no proof of pre-disablement income will be needed at claim time, and ancillary benefits. I mean, who's heard of specified injury? So this is all about matching clients to the features that are meaning and relevant for them, let alone with the spotlight being on some of the insurers around trauma at the moment and claims practices. It's good to see that advisors like Melinda Horton in this article is certainly investigating some of the claims of bad practice for life insurance payouts through the industry funds. So one of the things we wanted to do after this is certainly equip you with all of those bullet points that can lead to that discussion, but also do some of that analysis for you. I mean, if you wanted to get some of those comparisons of a industry fund versus a retail offer, certainly for advisors who want to partner with us, that's something that we can provide you and really give you some great ammunition if you don't have software that produces that for yourself. So level premium, we've talked about this, the ability to link as well and link your cover in super, all great reasons to have this retail discussion or blend discussion with a client. but certainly gives you a lot of ammunition against an industry fund, and even if that's just in dialogue with prospective customers. Finally, we want to set on with estate planning. This is a really interesting part, and I think this is where you can actually develop some real core intergenerational capacity, but also really serve your clients incredibly well. So on average, the number of clients that a financial advisor has a family relationship with is about 5%, and often that's positions being achieved by default, whereas as a contrast, advisors who've designed their intergenerational advice solutions, they find that they've got about 68% of new clients come from referrals from the family circle. And that difference between 5% and 68% is really alarming, because when you consider that there's studies out there that show that 39% of adult-aged children whose parents haven't actually explicitly reviewed it with their parents, and 61% who've got deceased parents stated that they never discussed their testamentary intentions with their parents before they passed away. And what results from that is that only 2% of adult children keep their inheritances with their parents' financial advisor. And when you look at widows, only after the death of their husband, only 45% of widows keep their assets with the same financial advisors. And most startling is that 70% of families fall apart and lose their assets after the transition. And what causes those family breakdowns is 60% were caused by internal breakdown of trust and communication within the family, but most importantly, 25% of those failures were caused by failure to prepare. Excuse me, I've got skier's cough, brought it back from the mountain with me. I forgot that I had a mute button. 25% were caused by the family's failure to prepare the heirs. So there's a really clear and powerful opportunity here. Financial advice businesses that can engage and assist current clients and their heirs to discuss, navigate and resolve succession and estate issues by positioning yourselves, the advisors, as the central hub of the process, you'll proactively be able to secure that mantle of the trusted family advisor. So what businesses have been doing to have success in this place is development of these estate planning capabilities, and far beyond the minimum requirements, which, you know, at its very worst is just a cursory paragraph in a statement of advice or a checkbox in a financial needs analysis. So a couple of years ago we ran some intergenerational advice masterclasses, and we discussed how do you position estate planning solutions with boomer and senior clients. And we found that the components of success, and that was in the masterclasses and in the follow-up piece, was definitely a pitch used to initiate the estate planning conversation, a template or set of estate questionnaires to highlight the potential issues. Certainly you need to have a relationship with an estate planning specialist solicitor firm, or perhaps in-house. The advisor of the year, Eleanor Dartnell, grew from a part-time legal person in there to full-time 2 people, just based on the power of how quickly her estate planning proposition grew. But most importantly, positioning the advisor as that central role of the facilitator. And some advisors even took it the next step, and they offered these assessment services to determine the capabilities of beneficiaries or guardians or executors and powers of attorney, and they would provide a report and an assessment to the will maker. And then upon execution of the estate plan, that advisor then engaged the key players in the process, the executor, the powers of attorney, the beneficiaries, to reiterate the plan and the ownership and the facilitation role of the advisor. So you can see what they've done. They've secured the next generation and then some in terms of new clients and securing that line and that longevity of those funds actually staying with the advisor. So they're certainly leapfrogging their competition. They're connecting with the next generation, and they're preparing heirs to receive and manage the wealth. And there's quite an important distinction here. It's historically the industry is focused on preparing assets for heirs, but these really progressive businesses have now beginning to do the other half of that equation, and they're preparing the heirs for the assets. So one of the ways we can help you do that, and we've got a really basic case study in here, which is, you know, for me it's just a rudimentary, fundamental. I'm sure all of you would be across this in terms of using equalisation and particularly insurance, and essentially using insurance to gross up the total value of the estate so that interested child or children receives the business in the instance of, say, something like a farm. So here we've got a business value, we've got 4 children. Off the 4 children, 2 work in the business and they'd like to retain it. But Susie and Michelle, who do work in the business but have absolutely no interest in any ownership, so how do we actually split that up? Of course, that conversation is of life cover and having an insurance discussion, and particularly, as we've mentioned before, considering level premium. Now, it's a really simple discussion. It's a really simple solution to put this in place, but it's not a discussion that people are actually having. And so we've tried to make it easy by having some work tools and processes for you. So we've got an estate implementation workbook that anyone who partners with NetWealth and ourselves are welcome to, and it goes through some of the research, some of the facts that you can convey to clients, but also goes through a process of how you put this in place. But also particularly once you get through some of our other client connection methodologies, is via flip chart. We've got the diagnostic, which talks about estate planning intentions and preparedness from a whole financial point of view, but particularly estate planning. And the other thing that we can do and give you access to, we do have licenses to an estate planning discovery tool. So this is a series of questions on estate planning, but also incorporates superannuation as well. And within about 5 to 7 minutes, provides a health check on someone's estate planning preparedness in a report. So when the client, you've sent a link out to the client, they complete this, they instantaneously get a report which talks about the issues that they need to discuss with you, and you get a copy of that report as well. And then you've got a lot of discussion, whether it be powers of attorney, be it preparedness for special needs children, be it preparedness for multiple or mixed blended families, businesses, etc. It goes through all the gamut. Smart questionnaire that only asks questions that are relevant. So if you answer you don't have children, you won't get asked any of those questions. If you answer that you do have a business, you'll get asked some more specific questions, but no more than 5 to 7 minutes. Now that's available, and we found the best success has been where advisors have targeted about 5 clients a week. They've sent this questionnaire out, they've followed up, and then it's led on to really robust estate planning strategy conversations, which then of course comes with the strategy advice fee, and then the implementation, and then the on solutions of insurance and also wealth and asset investment as well. So when it's targeted, when it's got a good diagnostic, and when we're using technology really well, there's a lot of opportunity here to have differentiated discussions with your clients. And that's a new screenshot of flip chart. You can see it's green, not Zurich blue, so if your colour's green, rest assured there's a full colour palette that you can brand this up and put your own logos on, and that's certainly available through Zurich. And as I said, in about 2 weeks you'll be getting where that misinsured table is, where the family's sitting on the couch. That's being replaced by essentially an insurance diagnostic, which I think you'll be really impressed with the icons and the functionality that comes out of that. It really is a robo advice, putting robo advice tools in your hands and allowing you to have an education discussion with the client all on one screen. So that's coming out in about 2 weeks. So what we're hoping is that you've got some ideas here. You've certainly interested in looking at some of these templates in collateral and diagnostics and client surveys that you can actually send out, and that we will want to arm you, of course, with as much as you can to highlight the value of retail funds versus industry funds, but also the benefits of running insurance through platform and how powerful a solution it is that you provide to clients when they actually do have advice versus people who don't. So if you do partner with us, we can certainly turn these great ideas into brilliant ones, and hopefully as the light globe pops there, you've got some great ideas to take away with you.